with the first quarter in the rear view mirror, the question is, what have we learned from the trading in the markets in the first quarter? And when it comes to me, when you look at the world from a top-down perspective and looking at the things that actually do control or move most other asset classes, in the first quarter it definitely was interest rates. So I'm going to show you guys a real simple and really important chart of 10-year U.S. Treasury yields. And I want to show you guys that the long-term trajectory that we've been in now for a long time, you'll see it remains intact. So this is actually a chart that I first showed on the YouTube channel here, and declines way before that, but the YouTube channel a number of months ago. And what I showed them is that the trajectory of U.S. Treasury 10-year yields have essentially since, I'm gonna say since 1987, have essentially been in this downward trend. Okay, and we did have an attempt to break out here in late last year, or actually not late last year, in the September period of last year. And ultimately, we saw the Fed making a big U-turn, and of course in December, and now the Fed is super dovish, meaning rates are not going to go higher. So in my opinion, what we've learned, the number one thing that we've learned in the first quarter of 2019, excuse me, I think it's really important, is that interest rates are probably not going to go a heck of a lot higher for the time being. Now, why is that important? It's important because interest rates are really important in general. So I'm going to show you a second chart right now, and that chart is of the S&P 500. And so basically, if I take what we learned from the bond market and I try to apply it to the equity market, here is where I think we are. I think if you look at the S&P and you look at it, what we want to focus on is this channel, these two black parallel lines. I think that for the most part, we are going to remain in this trading range. This is the SPY ETF representing the S&P. So we had a bit of a marginal breakout in September, a fake out breakout in September of last year, along with yields attempting to break out. And of course, we had an undershooting move take place. But for the most part, the meat of the action has been in between these two lines. So is it possible that the S&P overshoots a little bit? Absolutely, but I think for the majority, for the most part, given where interests are, given where global growth is, we're going to remain in this range. There'll be plenty of trading opportunities here, plenty of individual stocks and sectors and groups that will gyrate in both directions. But when you look at the S&P, this is probably where we're going to be stuck. In my opinion, again, it's largely predicated on what happened in the bond market. So that's it for today, folks. Hope this is helpful. See you guys tomorrow.